Have you ever wondered who really runs the world? Is it presidents, prime ministers, or monarchs? Well, what if I told you the real power lies somewhere else entirely? Somewhere far more discreet, in the gleaming towers of high finance. Today, we're diving deep into the fascinating story of how private banks became more powerful than any government. It all started centuries ago, long before the stock market tickers and digital transactions we know today. Think back to medieval Europe. Kings and queens were constantly at war, and wars are incredibly expensive. They need money for armies, weapons, and supplies. But where could they get it? Royal treasuries could only stretch so far. This is where the first private bankers stepped in. Families like the Medici in Florence and later the Fugas in Germany saw a massive opportunity. They began lending vast sums of money to monarchs. At first, it seemed like a simple business transaction, but these loans came with strings attached. When a king couldn't pay back his debt, the bankers didn't just send a strongly worded letter. They could demand concessions control over trade routes, rights to mine precious metals, or even a say in political appointments. Suddenly, these financiers weren't just lenders. They were kingmakers. They were influencing state policy from behind the scenes, all without ever being elected. This was the first hint of the immense power that came with controlling the flow of money. Fast forward to the 17th and 18th centuries, the world was changing. Global trade was exploding, and with it, the need for more sophisticated financial systems. This led to the creation of the first central banks, like the Bank of England. Now, you might think a central bank is a government institution, and today, most of them are. But many started as private ventures, owned by a small group of wealthy investors. The Bank of England, founded in 1694, was created to finance the government's war against France. In exchange for a massive loan, the private shareholders were given the power to issue banknotes and manage the government's debt. This was again, they controlled the nation's money supply, interest rates, and credit. The government became their biggest and most dependent client. Think about that for a second. The very institution that is supposed to represent the people was now deeply indebted to and reliant on a private company. This model was so successful that it was copied all over the world. Then came the Industrial Revolution. Factories, railways, and entire cities were being built from the ground up. This required staggering amounts of capital, far more than any single government could provide. Once again, private banks were at the center of the action. Figures like J.P. Morgan in the United States became legendary. He didn't just finance industries, he organized them. He created monopolies, like U.S. Steel, by merging competitors. He even bailed out the entire U.S. government during the Panic of 1907, when the financial system was on the brink of collapse. It wasn't the president who saved the day. It was a private banker. This event was a wake-up call. It showed just how much power was concentrated in the hands of a few individuals. This led to the creation of the Federal Reserve in 1913. While it's presented as a public institution, its structure is a unique hybrid system of a public governing board and 12 regional reserve banks, which are technically private corporations owned by member commercial banks. The debate about how much influence private banking interests have over the Fed continues to this day. In the 20th and 21st centuries, the power of private banks has gone global and digital. Through institutions like the World Bank and the International Monetary Fund, financial decisions made in New York, London, or Tokyo can have a massive impact on developing nations across the globe. When a country needs a loan to build infrastructure or stabilize its economy, it often turns to these global institutions. But the loans come with conditions, known as structural adjustments. These can require countries to privatize state-owned industries, cut public spending, and open their markets to foreign competition policies that directly benefit the international financial community. In essence, they can dictate the economic policy of sovereign nations. Then came the 2008 financial crisis. We saw how the risky behavior of a few massive private banks could bring the entire global economy to its knees. What was the response? Governments around the world used trillions of taxpayer dollars to bail them out. The argument was that these banks were too big to fail. Their collapse would be catastrophic. This moment perfectly illustrated the power dynamic. When private banks succeed, the profits are private. When they fail, the losses are socialized, paid for by the public. It has a system where governments act as a safety net for the very institutions that can destabilize them. Today, this power is more concentrated than ever. A handful of global megabanks control trillions of dollars in assets. Their decisions about where to invest, who to lend to, and what risks to take shape our world. They finance everything from tech startups to green energy projects, but they also fund industries that might have negative social or environmental impacts. They operate across borders, often using complex legal structures and tax havens to minimize their obligations. This makes it incredibly difficult for any single government to regulate them effectively. Their global reach exceeds the grasp of national laws. So, are private banks more powerful than governments? In many ways, yes. While governments have armies and the power to make laws, these global financial giants control the lifeblood of the economy. Money. They can influence politicians through campaign donations and lobbying. They can discipline governments by downgrading their credit rating, causing borrowing costs to skyrocket. And they can move capital across the globe with the click of a button, rewarding or punishing countries based on their policies. This isn't a conspiracy theory. It's the history of how our modern financial system evolved. It's a story of ambition, innovation, and the undeniable power of capital. The relationship between states and banks has always been a dance of mutual dependence, a push and pull for control. But over the centuries, the balance seems to have tipped decisively in favor of finance. So the next time you hear about a major government decision, it's worth asking, who is really pulling the strings? Thanks for watching. If you found this journey through financial history as fascinating as I did, make sure to hit that like button and subscribe for more deep dives into the forces that shape our world. See you in the next video.